If you've paid attention to investment markets to kick off 2026, you would know that growth stocks got hit hard in the first quarter. And to me, there's one big reason why this occurred. And in this video, I'm going to give you exactly that reason. So just as I said, growth sectors, technology, discretionary, and communication services, were some of the worst performing sectors of the first quarter. In fact, they were the three of the four worst performing sectors. So technology was down 9.3%, same as discretionary, and then communication services was down about 7.1%. On the flip side, some of the more cyclical sectors, such as energy and materials, performed really well. I actually had to cut off energy here. It was up about 37%. So it really threw off the swings of the chart. So I just wanted to zoom in a little bit and sort of exclude energy. So you could see that the growth sectors were in fact down a lot compared to the broad market. Now the growth sectors, specifically technology, tend to be really big. And so that's part of the reason why you see the S&P 500 there in the middle. The black bar was actually down 4.6%, despite some of the smaller sectors performing really, really well. And so if you're going to talk growth stocks, it's no surprise that the Mag 7 struggled in the first quarter. Now, we don't talk individual stocks on this channel. We cover macro. So this is certainly not me predicting about what's going to happen in the future. This is me simply showing you what happened in the first quarter. And here charted is the 7 stocks in the Mag 7. You can see that they're all down to varying degrees. Nvidia did the best at down 6.5%. All the way down to Microsoft at down almost 24% on the quarter. So the Mag 7, largely growth stocks, did not have a very good quarter. And so why is that? Here's the big reason. Growth stocks are allergic to higher interest rates. We'll talk about why interest rates move higher later in the video, but this is the core concept to understand from this video. Here I have charted the S&P Pure Growth Index in blue. On the left, and on the right, it's actually the S&P Pure Growth Index's price to earnings ratio. And then in both charts in red is the US 10-year yield inverted. So all of these charts that show interest rates are actually going to be inverted. So when interest rates are moving higher in real life, they're moving lower on this chart. So what you see here, we'll start on the left, when the US 10-year yield is moving higher, as it did throughout the first quarter, you see that the growth index moves lower. And then we're going to talk about PEs here. Same with the multiples. When the interest rate was moving lower, specifically in the last month from the end of February to the end of March, we saw that the S&P Pure Growth Index's price to earnings ratio really contracted from about 24 down to about 21. So 3 points of contraction there. And then that was the Pure Growth Index. You see similar relationships if you look at specific growth sectors. So on the left, you have the tech sector's outperformance compared to the S&P 500, with communication services relative performance compared to the S&P 500. And again, we're talking about the US 10-year yield inverted in both of these charts. So when rates are moving higher or lower on the chart, you see that the tech sector and the communication services sector tend to underperform the S&P 500, and vice versa when the US 10-year yield is moving lower or higher on the chart. So again, very similar chart to what you saw on the last slide, but we're just looking at the individual sectors. And so what was the cause? Well, the cause was higher interest rates, yes, but this was driven by an increase in inflation expectations. And now that we're getting some more data a little bit removed from the US-Iran war, we can see that it is actually flowing through to the headline inflation data. So I've probably used this chart 3 or 4 times at this point, but it really just encapsulates what's going on right now in the markets. So we have seen the price of oil increase dramatically since the US-Iran war, and now we are starting to see it flow into US CPI data. So April's headline number was 3.4%. That was up a full percentage point from February. So we saw this really large spike in CPI data, and it remains to be seen what the future of this war holds. So we've had a loose ceasefire agreement that almost immediately got violated. Now the US itself is blockading the Strait of Hormuz. I'm not a geopolitical analyst, but I imagine They're trying to starve Iran from its oil revenues, from selling their oil. And so if this is a prolonged conflict, this is a dynamic that we could probably expect to continue. Oil prices have moderated slightly from their peak at around 100 to 110. It was bouncing around. As I record this, it's in the 90s, but it's still quite elevated from the level that it was at the beginning of the year. So when inflation is picking up, you're generally not going to get Fed interest rate cuts. And the market was expecting a lot of interest rate cuts to start the year. You can see that there was over a 40% chance of 3 or more cuts that was implied by the market at the start of the year. And now there's almost a 0% chance of 3 or more cuts. And in fact, a 70% implied probability of no cuts or hikes. A huge portion of that is the no cuts portion. There's only a small implied percentage of some hikes. But as you can see, before the end of 2026, right now the market, at the beginning of the year, again, 3 or more cuts, is now expecting 0. And there's let me look, it's about a 20% chance, just eyeballing, of 1 cut that's implied. So we're not getting the same amount of Fed interest rate cuts, or at least the market's not expecting the same level of Fed interest rate cuts by the end of the year that they were at the beginning of the year. And so the US-Iran war that has led to a spike in inflation and inflation expectations has changed the market's perception of what the Fed is going to do. That has sent interest rates higher. And because interest rates have risen, growth stocks suffered in the first quarter. I do not know if this trend will continue. However, I am reporting on what happened. I hope you enjoyed this video. I will see you back here next week for another Macro Monday. If you did enjoy it, please don't hesitate to subscribe and like the video. I'll see you guys soon.